All right, today we're cracking open the can on Sherwin-Williams. You know, the paint and coatings giant just dropped its latest numbers, and it really paints a fascinating picture. They're coming off a record year, which is fantastic, but their look ahead is surprisingly muted. So let's dive in and really unpack why a record-breaking year is being followed by such a cautious forecast.
We're talking about a company that's been around for, 160 years? Their logo is literally cover the earth. You know, their performance is a big deal. It's often seen as a bellwether for the housing market and what people are spending in general. That's why this isn't just about paint. It's a signal for the health of the entire housing market and consumer spending.
And that right there, that's the big puzzle we're trying to solve today. The company just delivered record sales and record earnings. They beat Wall Street's expectations. And yet their forecast for 2026 is, well, it's anything but bullish. So what gives? Are they seeing something out on the horizon that we're not?
Okay, so to really understand their caution, we first have to appreciate just how strong their recent performance actually was. Let's take a look at the report card for the fourth quarter and really for the whole year of 2025.
First up, the bottom line. For the fourth quarter, Sherwin-Williams beat expectations on earnings per share, or EPS. They came in 6 cents higher than what analysts were forecasting. I mean, that's a solid win. It shows they're managing their profitability really well.
And it wasn't just on earnings. They also beat on the top line. Revenue came in almost $30 million ahead of what Wall Street was expecting. So far, so good, right? The numbers look fantastic.
And listen, this wasn't just a strong finish to the year. The entire year was a masterpiece. They set new records for sales and earnings, all while generating a massive $3.5 billion in cash. Simply put, 2025 was an absolute banner year for them.
But just as the victory lap was getting started, management started pointing to some clouds on the horizon. Despite these incredible results, they described the business climate as a softer-for-longer environment.
This quote from the CEO, Heidi Petz, on their earnings call, it says it all. For the third year in a row, think about what that means. All that record growth we just saw, that wasn't because of some booming economy. They achieved it by fighting against the market, not by riding some big economic wave.
And this really highlights the tug-of-war they're in. On one side, you have all these market headwinds. You know, consumers are feeling cautious. That do-it-yourself boom from the pandemic is definitely cooling off. Raw material costs are creeping up, and the housing market is kind of sluggish. But on the other side, you have the things they can control. Disciplined pricing, really tight cost controls, and just aggressively gaining market share. It's a classic battle of external pressures versus internal execution. So, if the market isn't going to help you, what's the plan? Well, this is where Sherwin-Williams leans on its well-honed playbook. It's all about focusing relentlessly on the things you can control and turning that market volatility into an opportunity.
And here's the game plan, broken down. First, they go on offense. They are relentlessly pursuing new customers and just stealing share from their competitors. Second, they protect the bottom line. That means raising prices to offset inflation while at the same time cutting costs. And third, they keep investing in the future, opening new stores, funding R&D, and making some pretty smart acquisitions.
Speaking of acquisitions, let's talk about Suvinil for a second. This is a huge paint company in Brazil that Sherwin-Williams just bought. It's a big deal. It adds a significant chunk to their sales. But here's the key detail. In the short term, it's dilutive to their margins. That's just a fancy way of saying that all the upfront costs of merging the two companies, new marketing, new IT systems, it temporarily eats into their overall profitability. It's a classic case of short-term pain for long-term gain. Okay, so that brings us to the final part of the canvas, the official forecast for 2026. Given this challenging market and their internal playbook, what do the numbers actually look like for the year ahead?
This table lays it all out pretty clearly. They expect sales to grow in the low to mid single-digit range. Adjusted earnings per share, they're forecasting somewhere between $11.50 and $11.90. They're also going to keep expanding, opening 80 to 100 new stores. And they're bracing for raw material costs to tick up just a little bit. When you put it all together, it's a forecast for steady, modest growth, a clear signal they're preparing to just grind it out in a tough environment.
And here's the key takeaway here. Management isn't trying to paint some overly rosy picture. They actually called this guidance very realistic. What they're doing is setting expectations they feel confident they can meet. They even said that if the market turns out to be better than they think, then they'll outperform these numbers. So they're managing expectations very carefully.
So we're left with this final question.
I mean, Sherwin-Williams has proven they can outperform even when the market gives them zero help. They have a clear strategy, a proven playbook, but as they face another year of economic uncertainty, the big question is, can their disciplined approach continue to create a masterpiece? Or will those persistent headwinds ultimately leave the canvas half-finished? That's the story to watch in 2026.